Hey everyone, Eric here. Thanks for tuning in. 2020 has been an emotional roller coaster of a year. It started with threats and memes related to World War III, a global pandemic, oil wars between Saudi Arabia and Russia, and has transitioned into one of the largest protests in US history against police brutality. Today I wanted to cover the economic impacts that were results of these events and where I think that we're headed financially in the United States. First, let's go back to the month of March. Since the financial crisis of 2008, there has been a gain of over 400% in the S&P 500. Thus, our economy was long overdue for a market correction. However, investors were blindsided by catastrophic events such as the virus that forced businesses to shut down and for millions of people to lose their jobs. Oil prices went negative for the first time in history, which literally meant that oil producers were paying buyers to take the commodity off of their hands. These two events resulted in major losses to the majority of investors' portfolios quite rapidly. The S&P 500, which tracks the top 500 companies on the New York Stock Exchange as well as the NASDAQ, lost 32% of its value from its peak in February. Now, the Dow Jones Industrial Average, which tracks the 30 largest companies in the United States, followed suit and had its worst point drop in history on Monday, March 16th, falling nearly 3,000 points. To put this into perspective, it took about 18 months for the stock market to lose 56% of its value after the 2008 financial crisis. In March, in the span of just 30 days, the market lost 34% of its value. The month of March obliterated all of the gains that were made since Donald Trump's election. Nearly 14% of workers have been laid off, which equates to 22 million people in the United States, with no definitive timeline on when they could return. The question is, how did we get here, and what are some steps that we should be taking in order to make the most of this situation? The first and most obvious cause of this financial meltdown was the pandemic itself. There have been more than 7 million cases worldwide, and it is apparent that it is much more dangerous than the seasonal flu, particularly for those at-risk individuals such as the elderly or people with pre-existing conditions. Another cause of the market's volatility are the oil wars that happened between Saudi Arabia and Russia. To summarize, these two nations continuously lowered the price of their oil per barrel in hopes that they can outlast their competition and dominate the oil industry. Another reason that Russia actually dropped its oil prices is due to the fact that the United States dethroned them as the top oil producer back in 2018, while accumulating a ton of debt in the process. Seeing how fragile that the US oil industry was, Vladimir Putin actually saw an opportunity to cripple the US factories. And needless to say, his plan worked. Major oil and energy companies such as ExxonMobil and Chevron were forced to cut their production, and it lowered their stock prices tremendously. Thus, the US economy took a huge hit as a result of these losses. Now fast forward to today. Now, in the wake of a war on police brutality, a high unemployment rate at 13%, and the threat of a second wave of sickness, miraculously the stock market is actually almost in the exact same place that it was prior to the illness. This may be due to a variety of different factors, such as the possibility of a vaccine being created as the economy is slowly starting to open up again. Although the stock market appears to have made a valiant comeback, I would be skeptical if I were you. Some of the biggest names in the investing world, such as Warren Buffett, have sold huge portions of their portfolios. And I don't know about you, but I would rather not bet against the best investor of all time. They say that riches are acquired or lost during recessions or volatile economic situations. This is why I personally have decided to stockpile the majority of my cash in high-yield savings accounts, which we can cover later. Now here's what I would do. First of all, don't panic. Nobody makes good decisions when panicked or drunk. Thanks, Dave Ramsey. Although there is a definite cause for concern, this is by no means an opportunity for you to pull money out of your 401ks or IRAs at this time. Let's say, for example, you decided to pull out your money when the stock market hit the bottom in March. If you had just held on for about a month and a half longer, you would have almost made back all of the money that you had lost previously. And just to clarify, you don't lose any money until you sell. So on paper, although you might have lost money on your investment, until you sell that particular stock or investment that you made, it really isn't a loss. This is why it's incredibly important to avoid trying to time the stock market and instead invest for the long run. For all of you big spenders out there, I would recommend using this crisis as an opportunity to learn how to live more frugally and invest your money properly. If you still have a job and haven't been laid off, I would take the necessary steps to become invaluable to your employers. Also, consider starting a side hustle that utilizes your strengths. Your financial well-being very well may depend on it. Before investing in the stock market, I want to make one thing clear. If you have any outstanding debt, pay it. A gain of 10% in the stock market is irrelevant if you are still paying 23% in interest on your credit card debt. It is also imperative that you have an emergency fund set up just in case you were to lose your job or your main source of income. This fund should be about 6 to 9 months of your annual income just to be safe. I recommend putting this money in a high-yield savings account such as any of the accounts listed here. In other words, at 1.5 APY or annual percentage yield, for every $10,000 in the account, the bank will pay you $15 per month, which is really good in comparison to the 0.06% national average that most savings accounts will pay you. My next recommendation would be to start a Roth IRA, which I covered in my previous video. I'll leave the link in the description below. I'd recommend using Vanguard to start your Roth IRA and investing entirely in index funds. A balanced portfolio may resemble 70% VTSAX, which is the total stock market index, 20% VTIAX, which is the total international stock market index, and 10% in VBTLX, which is the total bond market index. This will net you consistent returns in the long run and are highly diversified. Please note that this allocation is recommended for people between the ages of 18 and 39. Generally speaking, the older that you get, the larger your bond ownership should be. I also recommend against investing in actively managed funds. The individuals that manage these funds will charge you 20 to 30 times more than just investing in a passive index fund. If you'd like to dispute this point, Warren Buffett actually bet hedge fund managers $1 million that he could beat their portfolio of hedge funds over a period of 10 years with a simple index fund. Needless to say, he won. Now, $1 million is pocket change to somebody like Warren Buffett. But the point is that you can literally do nothing to your investments and still outperform the majority of money managers. I know I just shared a lot of information with you, but feel free to ask any questions in the comments below. Be sure to give this video a thumbs up, share it with your friends and family, and turn on notifications so that you are alerted every time that I post a new video, which is once or twice every week now. Follow me on Instagram at Eric_Anthony_Lopez, and feel free to check out my blog at millipreneur.blog. To those of you who have been saving your hard-earned dollars and living frugally prior to this market mayhem, I commend you.